Hello, today I will be talking to you about revenue recognition and the potential value you can drive by performing the required assessment and implementation. My name is Carl Newton, and I'm a director with Fidato Partners with over 13 years of experience as a CPA in the accounting profession. I have served a variety of clients in the technology and chemical industries, performing a variety of services from merger and acquisition support to financial reporting and technical accounting. My primary area of expertise for Fidato is around revenue recognition, of which I have extensive specific experience in, including performing and documenting revenue audits for numerous clients, including software-related considerations under the previous standard. I have also led several ASC 606 assessments and implementations. A little bit about the new standard. It is a uniform framework for revenue recognition, which has been established to improve consistency of revenue recognition practices across entities, industries, jurisdictions, and capital markets. It is to provide useful information to users of financial statements through improved disclosure requirements, and it simplifies the preparation of financial statements by reducing the number of requirements to which an organization must refer to. It's been particularly important as public companies are required to adopt the new standards after December 2017, with all private companies required to adopt the new standards after December 2018. So what are the 5 steps to achieving the new standard? Step 1, a contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Related considerations include approval and commitment contract rights, payment terms, commercial substance, and that collection is probable. Step 2, a performance obligation is a contractual promise to transfer a good or service to the customer. Each distinct promised good or service should be accounted for as a performance obligation. Step 3, the transaction price is the expected price in exchange for transferring promised goods or services, taking into account the following: variable consideration, financing, non-cash items, and amounts payable to a customer or concessions to a customer. Step 4, the transaction price for contracts with multiple performance obligations should be allocated to each performance obligation. Step 5, revenue is recognized when, point in time, or as, over a period of time, performance obligations are satisfied. Performance obligations are satisfied by transferring a promised good or service to a customer, and the customer obtains control of that good or service. So what's the potential value that can be realized from performing the 5 steps within the new revenue recognition model? Well, under Step 1, the new standard will require companies to have an effective contract management system. An effective contract management system will promote an improvement in customer relationship management. The centralized approach to accumulating and reviewing contracts will drive more contract uniformity and consistency, making managing client relationships easier and more effective. Increasing centralized corporate knowledge of global practices will allow for best practices to be incorporated when executing or implementing commercial changes. Performance of the assessment will also lead to lower costs, such as audit fees and other compliance costs, as it will become easier to provide documentation to support customer relationships. While performing Step 2, identifying and documenting separate performance obligations will force companies to truly understand the breadth and depth of promises made within contracts executed with customers. A byproduct of this exercise is that there could be more opportunities identified to increase revenue efficiencies, as products or services that might be provided for free or below optimal pricing would be identified through this assessment. It might even drive a broader understanding of the customer relationship that might not have been as apparent previously. Performing Step 3 in the assessment of identifying the true transaction price will also help improve revenue earning efficiency in limiting the number of processing errors and credit adjustments that need to be made to correctly and timely account for revenue. Also, It should lead to less volatile revenue recognition, as it could prevent companies from having to recognize unexpected large credits like volume rebates or cost-sharing costs at discrete periods, and instead plan for and recognize these potential adjustments over a period of time. A consequence of performing step 4 in the assessment is that companies will be provided with a better sense of the true accounting value associated with each customer promise being made. This could provide an additional data point for companies when considering the appropriate product, service, price mix. And finally, step 5, with a fresh look at the revenue process and improvement in the recognition process, it will make sales commissions and other incentive compensation easier to calculate and more accurate. The related improved financial statement disclosures will provide more relevant and useful information to potential investors and other financial statement stakeholders. So how do we get there? There will be processes that will have to be performed in parallel to fully assess and implement ASC 606 effectively, which will require overarching project governance. Initial adoption selections will need to be made, contracts will need to be evaluated, and disclosures developed in preparation for dual reporting. At the same time, companies will have to evaluate what they want their disclosures to look like and identify related data gaps. Companies will also have to evaluate their revenue streams and accumulate necessary data that flows into the disclosures that will ultimately be made. As companies go through this process, they will need to consider whether or not they need a project management professional, or PMP, whether they will need technical assistance, staff augmentation, or an IT solution, as well as the necessity to consider the impact on internal controls.
Thanks, Carl. So you just described the 5 needs a company could potentially have as they consider the assessment and implementation of ASC 606. But can you also tell us a little bit about how Fidato helps its clients address the new standards?
So how can Fidato help? The needs of the company will depend on the nature of its operations and types of revenue streams present. Each company will have its own unique set of circumstances to consider when determining what path to take from an assessment and implementation perspective. Fidato is uniquely positioned to provide the right level of assistance commensurate with the needs of the entity. We have highly experienced technical accountants with CPAs and years of experience serving both in public accounting and industry, with extensive experience working specifically in revenue recognition related areas. Fidato also has several certified PMPs on staff with experience in developing and managing the cumbersome complexities that come with this assessment and implementation. Further, Fidato has a risk management practice that has years of experience in establishing SOX-compliant environments, performing change management, and implementing IT solutions, which are also vital to the effective implementation of this standard. I want to thank you for listening.